to Chapter 9, Inventories, Additional Value Issues. So this will be the last test on the exam, well, the last chapter, excuse me, on the third exam, okay, which will be on the 22nd, so that'll be next Monday. We will cover Chapter 10 this week, though, but it will not be on Test 2, it'll be on Test 3. All right, so we're going to cover Chapters 9 and 10 this week, and then I think we do 11, week 7, and then Chapter 12, week 8, and then our final will be that Thursday. All right, so this will be on Test 3. All right, so this chapter covers a couple of different things. First, we'll look at lower cost of market, lower cost of net realizable value. Sometimes that are the market price drops our inventory below what we paid for it. So in the interest of conservatism, we will have to record that at the market value, net realizable value. All right, then not to be confused, but lower of cost of market, which really does use net realizable values as part of its definition of market. So we'll look at that, and we'll look at how that works. Then some other valuation approaches of inventory, net realizable value, relative sales value, and purchase commitments. And then we're going to look at the end of the chapter, or toward the end, some inventory estimation methods. One would be the gross profit method, using the gross profit percentage. You kind of probably remember what gross profit is. Sales less cost of goods sold is gross profit. And you take a gross profit, right, and divide by sales is your gross profit percentage or ratio. So that's kind of an important figure, particularly for retailers, their gross profit from their inventory that they're selling. And then we'll evaluate the gross profit method and some strengths and weaknesses. Same thing with retail inventory method, similar to when you see it, similar to gross profit. It's really used for clothing retailers. So we'll look at the concepts involved, and then there's two approaches. It's the conventional method and the cost method. All right, and then we'll evaluate it. And then at the end, finally, we'll look a little bit at the presentation on the financial statements of our inventory items. All right, so lower of costs are an NRV. So company may abandon historical costs, might find that shocking, but they're going to abandon the historical cost principle when the future utility, in other words, the revenue producing ability of that inventory, drops below the original cost. So something happened, a competitor has a better product or whatever, right? You've taken marketing classes, something's happened, and our product has lost value. So we're still going to sell it, but it may have lost value even below its cost. And that happens sometimes in organizations. Is really not a good thing. It means that we're probably not keeping up as much with our competition as we should. So the NRV, it's the estimated selling price in the ordinary course of business, not the replacement cost, I guess, less any reasonably predictable cost of completion, disposal, or transportation. So that's our NRV. It's kind of what we can get after paying these things. Okay, I got to pay to complete the item, or I got to pay to dispose it, or whatever. And what I get is called the residual or net realizable value. It's really the kind of the residual amount that's left. All right, so here's just a quick example of net realizable value. We got a company has unfinished inventory of $950, sales value of $1,000. The estimated cost of the item is $50, and the estimated selling costs are $200. How much is our net realizable value? So we've got the inventory value, it's $1,000, but it's unfinished. So we have to complete it. So that would cost $50, and we have to have some selling costs of $200. So we'll subtract those out, and our net realizable value, what we get after selling this inventory off and finishing it up and selling it off, $750. All right. So in the balance sheet, we'll record $750 of inventory costs, right? And that's the net realizable value of $750. In its income statement, we'll report a loss due to the decline of inventory to net realizable value of $200. Okay, so it went from $950, was cost of the inventory originally, down to $750, mainly because of these costs to complete, cost to sell. All right, here's an illustration of lower cost versus net realizable value. And normally when we do this, a net realizable value approach, that will look at each individual item. Companies will do this. So they will cost and NRV to look at cost versus NRV on each individual item. Now you don't have to do that way. You can do it on a composite of items, or you can do it on all your items. We'll see that in a minute. So for this company, you got cost of 80 for spinach. 80 NRV is 120, so the value is going to be 80. Carrots, we're going to use either one, right? It's equal. Cut beans, though, we'll use the net realizable value because that's lower. Same with peas. And then mixed vegetables. So we add those up, and 384,000 would be our value of that inventory, final inventory value. All right. So here's another approach. So this is, let's say you could do it by individual items that we just did. So that was 384,000. You could do it by major categories. I got frozen. So net realizable value versus cost, lower of cost, lower of cost or NRV is cost for that one. So I got 230. So that's good. Frozen foods are doing well. So you use the 230, which is our cost, which is what we prefer using. And then the canned, where the cost is 184, the NRV is 164. So something's going on with canned peas. All right, so because of that, we're going to use the 164. Right? Then NRV is lower than the cost, so we use the 164. So total would be 394 by major category. So that would be our lower cost to market by major categories. And then if I just added all the inventories up, I'd use cost, right? Because total cost of 415 is less than total NRV of 424, so 415 for this one. But as I mentioned earlier, it's really the individual item. Doing it one by one is normally what companies use when computing NRV. All right, so here is another example of recording net realizable value instead of cost. So following data is for Ricardo. Your ending inventory cost is 84,000. At NRV, it's 70,000. So adjustment, lower cost or NRV, so it's adjustment down by 12,000. So we can make a journal entry, loss due to decline in inventory, and debit inventory, or we can debit cost of goods sold for 12,000 and credit inventory. Normally, when we do this, we'll set up an allowance account. So we'll use this first part, we'll loss due to decline in inventory of 12,000, but what we'll credit, just like bad debts, we'll credit an allowance account, allowance to reduce inventory to net realizable value. And then on your income statement, you would want to show your inventory, in this case, at net realizable value, right? Because it's lower than cost. All right. So if I use the loss method, I would show this $12,000 as a contra inventory account on the balance sheet. If I just float it through cost of goods sold, I would have a decrease in cost of goods sold of 12,000. So either approach is okay, is good. Probably the allowance approach is more beneficial in that you can see what's going on with your inventory. You can see the fluctuations and the differences between net realizable value and costs throughout the year by looking at the entrance, looking at these entries to the allowance account during the year. All right, so probably, but this is more of a balance sheet method, and this would be, the 12,000 would be the balance sheet approach, give you a stronger balance sheet, and the other method is more of a income statement method, and it gives you stronger cost of goods sold. All right. So, recording NRV instead of cost, and this is the income statement, what your income statement would look like. You would have a loss on your income statement of 12,000, and then you have a reduction of cost of goods sold, in this case, to 132. All right. In general, accountants adjust this a balance at the next year at year end to agree with the discrepancy between costs. So it's a reconciliation, right, between cost and the lower cost or net realizable value at the balance sheet date. Okay, so the use of this approach works well to measure our declines of the value of our inventory. FASB decided to grant exception to this approach for companies that use the LIFO or retail inventory methods. Under this approach, companies can compare a designated market value of the inventory to cost, and that's commonly called the lower of cost or market method. So this is only available if you're using LIFO or retail inventory method. A lot of companies use LIFO. I think the most popular inventory method, number one, is LIFO. All right. So this approach, we're going to show this, is this approach, this alternative approach, has you do kind of three market values. You have a ceiling, which is a net realizable value. You have a replacement cost, and then you have the floor, which is the net realizable value minus a profit. Okay, so we can take a look at this. So assume that Parker Company has unfinished inventory of the sales value of 1,000, estimated cost of completion and disposal of 300, and a normal profit margin of 10% of sales. Parker determines the following net realizable value. So inventory, less cost completion disposal, right? So that's going to bring us down to our net realizable value, and then we have a allowance for normal profit margin 100. So that's our floor. So our floor is 600, and our ceiling is 700. All right. So let's take a look. Okay. So rationale for ceiling and floor. Well, ceiling, we don't want to overvalue our inventory. So it's only going to be this high. It can only be so high. And the floor is that we don't want to undervalue it either. We don't want to take extra losses. So we're involved in income smoothing and those kinds of things we talked about in previous chapters. So the ceiling would be your NRV, replacement cost would be between, and then floor would be your net realizable value less any normal profit margin per unit. All right, so we'll see an example here in a second. All right, so what's the rationale? So ceiling prevents overstatement of the value of obsolete, damaged, or shop-worn inventory. So we don't want to do that. We don't want to overstate, particularly inventories that should be written off, right? We don't want to overstate those. And then the floor is that we don't want to understate either, because that leads to income smoothing, and that's you're not going to be fairly presenting your financial statements in accordance with GAAP. All right, so here's how it works. And actually, let's look at the next slide, because this looks a little better. All right, so here's my costs for our company. We have the same company with the vegetables, right? So I have spinach 80,000, carrots 100, cut beans 50, peas at 90,000, and mixed vegetables at 95. Then this is my replacement cost. So this is what I can expect. So this is sort of that value that you found for that amount. So it's the amount I can expect to replace those units for. All right, then my ceiling would be my net realizable value. And then my floor would be my net realizable value less the profit margin. Okay, so in this case, I guess the profit margin, 16,000. All right, so if replacement falls between ceiling and floor, I can go ahead and use replacement. So on all these, let's see if that happens. All right, on the second one, carrots, 90,000, that's between 100 and 70. So I'll use that for my market. Okay, and then What else we got? This one, nope. This one, no. I guess that's the only one for our replacement cost. The only one. That is the first one. Second one, 90,000. All right, now, if the replacement cost is above the ceiling, we had to pick ceiling. If replacement cost is below the floor, then we had to pick floor for market. So for this one, replacement's 88. So it does not fall within the range, right? The range is 104 to 120. It's 88. It's below the floor. So I'm going to use the 88. I'm sorry, I'm going to use the 104. Excuse me. I used the 104 for my market price because the 88 is too low. We might be trying to get away with something here, right? Trying to undervalue those inventories. So the 88 is too low, so I'll go up and just use that floor. So if it falls below the floor, then I use the floor. If it's above the ceiling, I'll use the ceiling. If it's in between, I'll use replacement cost. So we talked about this one already. This was between floor and ceiling, 90,000. So that's our market for that. Cut beans, it's 45,000. So it looks like it's above the ceiling. So we're going to use the ceiling of 40,000. Right? So if it was 35,000, I could use 35,000 or even 39,000. But because it's above the ceiling, we'll just use the ceiling for our market. All right, the next one is replacement's 36. So that's below the floor. So we'll use the floor for market value of 48. And the fourth one for the mixed beans, replacement's 105. That's above the ceiling, so we'll use a ceiling of 92. All right, now, so these are my markets. And I'm going to compare that lower cost to market. So what's lower, 80 or 104? 80. So lower cost to market would be cost. So that's good. I mean, I'd rather have it as your cost. Carrots, lower cost to market. Looks like our market's 90. Cost is 100, so we use the 90. Market of 40 versus cost of 50, use the 40. Market of 48, uses versus cost of 90, so we use the 48. And then cost of 95 versus market of 92, so we're going to use the 92. So I add these up and I get 350 for my lower cost of market and 415 for my cost. I'm going to use this 350. And because we're using the 350, we've got a decline, right, of 65,000 in market, so I'll make an entry. Loss due to decline of inventory. Use the allowance approach. Credit the allowance account to reduce inventory to market for 65,000. So there are some issues, conceptual deficiencies of the lower of cost or market method. So expenses are recorded when lost in utility. So it doesn't really match matching. It happens, some competitor has a new product that's like ours, but it's much better and cheaper or whatever. And so now we can't sell our product anymore, or it's lost value, it's lost utility. But that doesn't really, does not really meet the matching principle criteria. So the expenses don't match up with revenues. The expenses basically the reduction in value. Inventory might be valued and cost in 1 year and market next year, so it's an inconsistency. Net income in the year of loss is lower, but then in subsequent periods it may be higher if those reductions didn't take place. So there is some judgment going on here, right? And that's what I think they're trying to talk about here, that so you got net income in the year of loss is lower, and then we're supposed to have these higher, or we're supposed to then have kind of a, not higher, but same amount of income. But what happens is the reductions didn't happen. So the competitor had a new product, but it really wasn't as good as ours. Found out ours was better. All right, so those reductions didn't happen. So because of our judgment, that might not have been correct, that could affect income. It looks like might affect income where it's going to be lower. So, and then we do use a normal profit in determining inventory values, which is subjective. What's normal profit? But we use normal profit margin when computing floor. What does that actually mean? Some other approaches. Evaluation at net realizable value permitted by GAAP under these conditions. Controlled market, quoted prices, no significant cost of disposal, or it might be too difficult to obtain cost figures. All right, so if you do that, then you can value your inventory at net realizable value. All right, other valuation approaches. Relative sales value used when buying various units in a single lump sum purchase. So we have a good illustration of this. Woodland developers purchases land for $1 million that it will subdivide into 400 lots. So these lots are of different sizes and shapes, but can be roughly sorted into three groups, A, B, and C. How they're graded. As Wooded sells the lots at portions the purchase cost of $1 million among the lots sold and the lots remaining on hand, calculate the cost of goods. So we're going to use relative sales value to allocate cost. All right. So if you look here, we have for A, 100 lots, cost $10,000 per lot, right? So I have $1 million. Once I sell everything, right? I'll have $1 million in sales revenue. And then for B, I got 100 lots, 6,000 price per lot, so that's 600,000 there. And then the third one, 200 lots, $4,500 per unit, so 900,000. All right, so relative sales value. So we look at A. A is 40%, isn't it? 40% of the total sales price. B would be, I believe, 24%. C would be 18%. If that works out all right, but this one's 40%. So we're going to allocate 40% of the costs. So it's 40% of the total revenue, and we'll allocate 40% of the costs, and that's 400,000. Then B, it's 600,000 total sales price. All right, and divided by 2.5 million, so that's around 24%. Okay, and so that's 240,000, 640. So the other 360, so it's 360, and I said 180, but it's 360 because there's 200 lots. So cost allocated lots, it's 900 divided by 2.5 million, which is 36%. So 360,000 would be the cost allocated to the lots. And then the cost allocated per lot is 1,800 because they divide by 200 instead of 100. All right, so that's how you allocate those costs. So 400, 240, and 360 based on relative sales value, revenue amounts of the three classes of lots. It's a little problem we come up with sometimes in inventory is a purchase commitment. In a purchase commitment, in general, not always, but usually the seller will retain title to the merchandise. So there is no asset or liability, right? Because no exchange has taken place yet. So in other words, commitment means that we're going to buy that inventory, but we haven't paid for it. But they've set it aside for us. All right. Now, if it's a material amount, the purchase commitment, say it's 30% of our inventory for next year, we need to disclose those details in the notes to the financials. All right. A problem can arise if the contract price is greater than the market price and the buyer expects that the loss will occur when the purchase takes place. So the buyer should recognize those losses in the period during which such declines in the market price take place. So the purchase commitment, even though we haven't taken title, it still means that we're committed to that inventory and we're going to buy the inventory. And we know even before it hits our shelves that we're going to probably take a loss on it. All right. Here's another example. St. Regis Paper signed timber cutting contracts to be executed at a price of $10 million. The market price drops to $7 million. So make the following entry: unrealized holding, gain or loss, income, and credit to estimated liability on purchase commitment for $3 million. So this would go on this unrealizable holding, gain or loss, and income would go on the other expenses and losses in the income statement, and then the estimated liability on purchase commitment would hit your balance sheet. So we have in goods like mineral goods, we have a material loss because of the market price. Whatever's going on with the market, we do need to report that as an unrealized holding gain. Now it's unrealized because we haven't sold this stuff yet. So it's unrealized, and it could come back. As a matter of fact, we show down here it does come back. But up here, when St. Regis cuts a timber and it costs $10 million, makes filing entry, debit inventory, $7 million. Right now they have title to the inventory and possession of it. Debit the liability on purchase commitments $3 million, and then credit cash for $10 million. But Congress permitted St. Regis to reduce the contract price, and therefore the commitment was reduced by $1 million. So we can reduce the liability and then reduce the loss, basically recording that as a gain. So instead of our loss being $3 million, now it's $2 million. So we have an unrealized gain here of $1 million because Congress is allowing St. Regis to reduce their contract price and their commitment by $1 million. So that benefits us, so that we won't be on the hook for the whole $3 million, but only $2 million. All right, substitute measures to approximate inventory. So we're going to talk about some of those. And the first one will be the gross profit method. And then the second one will be the retail method. So beginning inventory plus purchases equals total goods, right? Goods available. Goods not sold must be on hand. So the sales reduced to a cost figure deducted from the sum of the opening inventory plus purchases equals the ending inventory. So here's an illustration. So Cetus has beginning inventory of $60,000. Purchases of $200,000, both at cost. Sales at selling price amount to $280,000. The gross profit on selling price is 30%. So Cetus applies the gross profit margin method as follows. All right, so our beginning inventory is $60,000, and we add to that purchases. So I've got goods available for sale of $260,000. My sales are $280,000. Gross profit is 30%. So gross profit is, remember, your gross profit in dollars divided by sales. All right. So gross profit is 30% of the 280, so the 84,000. So we're going to take that out. What we're doing is, our sales consist of gross profit and cost. So we're taking the gross profit out, so all that's left will be sales at cost of 196. So subtract that from the 260, and our approximate inventory at cost would be 64,000. All right, so gross profit, if you have an article that costs 15 and sells for 20, has a gross profit of 5, 5 divided by 20, markup, divided by retail at 20 gives us 25% gross profit at retail. But at cost to be higher because we just take the markup of 5 and divide by the cost of the article, $15. So there it's going to be, on cost, it's going to be 33%. All right, so gross profit on selling price. So these are the percentages we're going to need to worry about here, these gross profits on selling price. So if I give you the markup of 25%, take 25%, divide by 1 plus 25%, and we end up with our rate, gross profit rate of 20%. Or if it's 50, I take 50 and divide by 1 plus 50, and then the rate is 33%. All right, so let's look at the gross profit method. Astaire used the gross profit method to estimate inventory for monthly reporting. Presented below is information for the month of May. So we have inventory, purchases, freight, and sales. Sales return, purchase discounts for various amounts. Compute the estimated inventory, assuming that gross profit is 25% of sales. And the second part is assuming that it's 25% of cost. All right, so for the first one, we're assuming it's 25% of sales. So I got beginning inventory plus purchases, less discounts, plus freight in. So of 818,000 are my goods available. All right, and then I'm going to deduct from that my sales, less sales return, so net sales are 930. Then the gross profit's 25%, gross profit of sales, 25% times 930. So you got 232, 500. Sales are 697, 500. If I take the 930 and divide by, subtract off that 232.5, I've got my sales at cost of 697, 500. So if I take my goods available, so goods available are going to go two places: inventory and sales. So the sales part is 697, 500. The other part has to be my ending inventory of 120, 500. All right. And then we're using it, assuming it's 25% of cost. What you need to do here is convert, using the gross profit method, you're going to have to convert the gross profit rate based on cost to the gross profit base based on sales. So as we showed before, 25 was the percent of cost, right? So 25 divided by 125, that's 20%. All right, and that's what we'll use to find the gross profit. All right, so same as the last sheet, we find our goods available, take our sales, less sales returns, or net sales, convert the retail value of sales to cost value by subtracting out the gross profit, the markup of 20% of 930, which is 186. So our sales are 744,000. I got 18 goods available for sale. 744 is sales, and the rest of it, 74,000, must be our inventory or approximate inventory. So remember, these are approximations. Gross profit and the next one, retail method, are both approximations. All right, so evaluation of the gross profit method. Obviously, it's an estimate. That percentage is an estimate. And it's based on forecasts and subjective measures. It can rely sometimes on past percentages in determining the markup. That's not always true, but a lot of times we look at current information, what current organizations are doing. But a lot of times it also relies on past percentages. Care must be exercised when, due care must be exercised when applying a blanket gross profit rate, when there are a number of varying gross profits that are used throughout the firm. Normally, it's really unacceptable to use gross profit method for financial reporting. If you're going to use it, you have to have a physical verification. In other words, you have to count all your inventory if you're going to use that. So companies don't normally use it. They use it, but it's used more for estimating rather than for FASB. All right. So that brings us to the next method, the retail inventory method. So let's use our retailers, usually clothers, JCPenney. The value inventory without a physical count by converting retail prices to costs. It's kind of similar to the gross profit method, as you'll see. So total cost and retail value of the goods purchased must be kept track of. Also goods available, and then sales for the period. All right, so Fuchs Incorporated uses a retail method to estimate ending inventory for its monthly financials. The following data pertain to a single department for the month of October. All right, so we're going to use two approaches. They're almost the same. They're almost identical. It's conventional and cost is just how we handle our markdowns. All right, almost identical. All right, so for the retail method, it's kind of the same thing as before. We're going to compute goods available. So at cost, I've got beginning inventory plus purchases plus freight less any returns. All right, so that equals these three are 283, and then add the 52, so 335 is my goods available for sale. All right, then on the other side, on the retail side, we start with the retail value of the inventory, 78. Purchases were 423, subtract returns of 8, add markups. Well, these retail companies have all these markups, right? So we add those, and that's 422. So 422 plus 78 is 500. So 335 divided by 500 will be your rate of 67%. So that's your rate, basically your cost rate. So now I've got goods available for 500. I got some markdowns. So I'm going to subtract those out. and in the other method, in the cost method, they're actually subtracted out up here, which is probably more appropriate in my opinion. We subtract out spoilage here, and then sales, right? Remember, goods available for sale, basically two things: sales or ending inventory. All right, so and then we have this spoilage. So normal spoilage kind of happens in the normal course of business, and marked down to 3,600. So my ending inventory at retail would be 96,400. All right, and I now need to convert that to my cost. Ooh, wow, where's that? Okay, so I take my 96.4 and multiply it by my rate of 67%. So 64,588 would be the retail inventory method amount. Retail inventory method amount, 64,588. Using the conventional approach. All right, cost method, pretty similar. The only difference was markups we're going to put above the line, 7,000. So we got beginning inventory plus purchases and other costs, returns, markdowns, and markups. And that you have just with retailers, so it's nothing you have to worry about. They're not a retailer, obviously. So 418.4 would be my purchases plus those other costs, plus 78, so 496.4 would be my goods available. And then on this side, it's 335. It's I think same as before, 335. So 335 divided by 496.4, because the markups are now up here, we got a little higher rate, 67.49, multiplied by my inventory of 96.4, right? So the goods available, 496.4, less spoilage, less sales. So ending inventory then at retail is 96.4 multiplied by the rate of 67.49%, 65,056 would be my amount for inventory using a retail approach. Again, this is really not used for GAAP, but we use it maybe for an insurance claim. We use maybe to investigate whether we have, we want to investigate whether we have shortages of inventory, yet we don't want to do a full inventory count. So maybe we'll do a partial inventory count and look at this and extrapolate and look at this information and see, oh, well, maybe there is an issue with inventory security, sure. Okay. Some issues. So there's some other costs, and we talked about some of these already. We saw how these were: purchase returns, purchase discounts, normal shortages, abnormal, employee discounts. So we're going to see how to handle these special items. So we saw this before. The purchase return would be reduced to get to my total purchases. Markups are going to be added. Abnormal shortage though will be deducted up here. All right. So it does, in other words, when you put anything above, it's going to affect your percentage. All right. So my beginning inventory is only 1,800. Then we add these other costs of 60 less the 3, and so we have 58.8 here plus 9 less a 2. So 65.8 was my total inventory cost at retail. 28.9 though would be my numerator. So 43.9% would be my gross profit ratio. All right, so then on the bottom, we can deduct from 6,500 any net markdowns. So it looks like we're still using the conventional method. And then we'll subtract out sales, right? Sales less sales returns. And then employee discounts would need to be deducted, and normal shortage would be deducted down below. So they wouldn't affect your percentage. But my inventory ends up being 27,200, right? The goods available are 65.8. The sales are somewhere around 38,000. All right. And then my inventory. So sales are, let me figure this out in my head, $39,100, I believe. 39,100 would be your sales with adjustments. All right. So, anyways, so my normal my ending inventory is 27.2. So sales are 39. I believe 39.1. Goods available for 65.8. Subtract out the sales amount. We end up with ending inventory of 27.2 once at retail. So now once we found this percentage, we did that earlier, we can multiply the 43.9 by the 27.2. So 11.9, 40 and 80 cents would be my inventory value under the retail method. All right, so retail inventory method, I guess the advantages are sort of the same as gross profit. We don't want to count the inventory, but I do want to, compute net income. I do want to find out how much inventory is. It can help us measuring inventory shortages. It gives us information that we may have inventory shortage. Can regulate our quantities of merchandise on hand. So if we do this every month, we can see, hey, maybe this is too high. Maybe there's too much quantity on hand. And then maybe it can be used for insurance if there's a claim, there's some inventory that was lost or damaged, and that we might be able to use the retail value inventory method information to help with our insurance claim. All right, so presentation. So accounting standards require disclosure of composition of the inventory, financing arrangements, costing methods, consistent costing or not changes from LIFO to FIFO every period, inventory composition either in the balance sheet or in a separate schedule in the notes. So in other words, what's your inventory made of? You can have a schedule in your notes about what makes up your inventory, what items make up your inventory. Accounting standards also require disclosure of significant or unusual financing arrangements related to inventories. So maybe some of the inventories are restricted, and that's number 5. Pledges collateral for a loan, and that should be reported in the current assets section rather than as an offset to the liability. All right, and then basis on what's the inventory state. Is it lower cost of market? Is it historical cost? And then the method used in determining cost, LIFO, FIFO, average cost, specific identification. All right, so a little bit more here is just an example. You can look at that on your own of Fortune Brands in Wyoming, of their presentation of their inventories. And then we have finally some common ratios used in evaluating companies. Inventory turnover. And I remember Dell Computers, I probably remember Dell Computers. They were amazing when they first started. They were just churning out all these computers, but their inventory turnover was every 3 days. They would turn over all their inventory every 3 days. Obviously, they were like a low profit margin, but very high volume. All right, and that was a long time ago, but I kind of remember that. I'd never heard that. Inventory turnover. So the higher this number is, the better. The more you turn over, the better. It's just cost of goods sold divided by inventory. So this company 7.53. Now the other thing is you want to compare it, and there's information done in Bradstreet and so forth information. You want to compare it, that number, to other numbers in your industry, and then also maybe your own continuous improvement. Maybe we have a goal that it's going to be 10 times. So internal inventory 10 times. And we're at 7.53, and then so we have some measures and approaches we're going to use to increase that. Average days to sell, that we just take 365 days. We know what that is, right? And divide by the inventory turnover. And so in this case, it's every 48 days takes us to sell our inventory. So take 48 times 7.5, 48.5 times 7.53. I bet you're somewhere close to 365. All right, well, if you have any questions, give me a ring or a text, either way, or email me. Sorry, these up a little late. I've had really bad asthma last couple of days, so I haven't really been able to talk until now. But I do appreciate you. I'm trying to get a review sheet up earlier this week. I'll probably try to get up Wednesday or Thursday, give you more time to review. Wiley was down, I think, today, so if you're having trouble with that, I apologize for that. I'm going to give you few extra days, to do 7 and 8. So if you haven't done those, so you need to turn those in, say by the end of the week, say by Friday. All right, not too much of a stickler really on homework. All right, well, if you guys have any questions, just email me or give me a call. Appreciate your attention.